Welcome to part 4 of the Wheel Strategy series, where I introduce what some members of my options trading club have called the Patricia Special. I'm trading both sides at once, a cash secured put and a covered call on TROW price, a Dividend Aristocrat. You'll see me place trades in real time on ThinkorSwim, log them in my spreadsheet, and explain what's going to happen over the next few weeks. I'll show you how this double Ferris wheel setup can generate income from puts, calls, dividends, and capital gains while reducing my adjusted cost basis over time. TROW price is trading at $92.26 a share, and I'm going to buy 150 shares. It filled at $92.25 a share. So I've just spent $13,837.50. The next ex-dividend date is June 13th, and today is June 2nd. The next option expiration date is June 20th. There's no way to sell a put that will expire before the next ex-dividend date. So I'm going out to July, and I'm going to sell a cash secured put with a strike price of $90 expiring on July 18th. It filled at $2.74 a share. And now I'm going to sell a covered call with a strike price of $95. It filled at $1.90 per share. Now let's take a look at where this position stands right now. And then we'll look at the possible outcomes for July 18th. I bought 150 shares, spending $13,837.50. Then I sold a cash secured put with a strike price of $90. So I'm using $9,000 of collateral to secure it for an annualized rate of return on that $9,000 of 24.10%. With a covered call, since I paid $92.25 a share for the 100 shares that are being used to secure it, I'm going to use $92.25 as my collateral value. So on the covered call, that $189.34 of premium brings me a 16.29% annualized return. I also know that on June 27th, there will be a dividend reinvestment. I don't know what the share price will be at that time, but I do know that I'll get $127 a share times 150 shares. So $190.50 will be reinvested to buy probably about 2 shares of TROW price. So by the time we get to June 27th, instead of 150 shares, I'll have 152 shares. I'm going to sum my total expense and income for today. Bought shares, sold a put, sold a call. So my total out of pocket right now is $13,374.82, and I'm going to divide that by 150 shares. So my current break-even price is $89.16 a share for 150 shares. Now, let's look at what could happen on July 18th. If TROW price is trading below $90 a share, I will be assigned to buy 100 shares, and this $900 of collateral will be used to pay for them. So I'll spend another $9,000. If that happens, I will have bought 150 shares, sold a put, sold a call, and bought another 100 shares. So at that point, my out-of-pocket will be $22,374. And I will own 250 shares plus the shares that are purchased with the dividend reinvestment. Since I'm estimating that at 2 shares, I'm going to divide this by 252 shares. So this shows me that if I am assigned to buy 100 more shares, paying $9,000 for them, my average cost per share at that point will be about $88.78. If on July 18th, the share price is between $90 and $95, both the put and the call will expire worthless. No shares will change hands, no money will come in or out of my account. My out-of-pocket cost will be exactly where it is today, and I'm going to divide that by 152 shares to account for the shares that I'll get with the dividend reinvestment. So I'll have 152 shares about, and my average investment per share will be about $88. And if the share price rises above $95, let's say it's at $96 a share, then I will be assigned to sell 100 shares and I'll receive $9,500 for them. If that is the outcome, I will have bought shares, sold a call, sold a put, received another couple of shares through dividend reinvestment, and then sold 100 shares at $95 a share. So at that point, my out-of-pocket would be $3,874 and some change, and I would own 52 shares. My average investment per share for those 52 shares will be $74.51. Since the call and the put can't both go in the money at the same time, this setup creates steady income with limited downside. If my calls get assigned, I still hold shares for the upside and the FOMO and reinvest the dividends to grow the position. It's a smart way to build a strong dividend position while reducing my adjusted cost basis over time. Want to learn how to do it yourself? Watch the full series, check out my book, or take one of my courses. Everything's linked below.